Hey traders, welcome to Charts and Coffee. Happy Tuesday, everybody. We have the PPIs. We have alphabet soup coming out this week. Aside from the OPEX on Friday, we've got a lot going on this week, and you'll see that we've got the aftermath of the PPI playing out. So let's go ahead and take a look at what we've got going on right now. And, oh, wrong layout. All right, let's get this layout sorted out. So the thing that we want to keep in mind in terms of the reaction to the PPI is it's not going to be as intense as the one for the CPI tomorrow, because the CPI is more of a direct data point on inflation. Now, I will tell you, the inflation metric is going to be a tricky one right now, because we're already discounting the rate cuts in September on the September 18 meeting. And one of the things that we've seen the last week or so is that actually since non-farm payroll, we've seen the reaction of bad or disappointing data being negative. And for many, many months, for the year really, if data came in as a miss, then, for example, jobs came in lower, or inflation was, well, let's take the inflation out of it. But if jobs were lower, if jobless claims were higher, just negative metrics on the employment picture, equities went up, because what it did is it just kept reminding the Federal Reserve that A, you need to cut, maybe B, you should have already cut, which was probably a big part of non-farm payrolls reaction. Hey, Jerome, you should have known this jobs number was coming on the 31st. You should have given us that quarter point. And hence we saw the overreaction on NFP the first Friday of this month. All right. So now we're really operating in a good data needs to be the reason equities move higher. And we'll see how long that lasts. It does seem to be in place for now. Might we go back down the rabbit hole? Yes. As we're looking at rate cut expectations taking us out, clear out into potentially June of next year, there might be months where we need that miss to wake the Federal Reserve back up again. Hey, Jerome, stay the path. Things aren't where they need to be yet. And by the way, in the meantime, the data is also going to be sort of bounced off this concept of this growth scare, which again, a lot of these things are just manufactured by financial media. For the last decade, the U.S. economy has grown about 2 to 3% per year. And we're still in that window. We might be at the lower end of that window, but we're still in that window. But again, remember, it's always going to be clickbait. It's always going to be, what is it that I can rattle your cage with? And right now it's this notion of a growth scare. And every now and then when they need viewership, oh yeah, now it's recession again. We've probably come in and out of recession numerous times over the last 2 years, right? But keeping that in the narrative is a very powerful mechanism by which to keep people tuned in, to insist that someone else should be managing your money. Think about it, gang. I'm not trying to be a conspiracy theorist here, but these are pretty basic concepts in terms of the way Wall Street likes to operate. All right, that being said, where are we right now? Now, remember, these are the folks on the 5th, on the 6th, that didn't want to do anything but remind us about growth scare, carry, unwind 2.0. And we came out on that day and said, look, I showed you all the interest rate differentials. And I said, is there really a reason for all of the carry to have to unwind? Or could some of these hedges, these currency hedges, could they have been just for one day? Yes, we went way beyond a 1 standard deviation move. It was 5 standard deviation move. But were all the carry trades going to break because the Bank of Japan went to just under 0.25% when there's still well over 3 to 4, in some cases 5% difference between what the yen could be borrowed at and what the dollar, the pound sterling, the Canadian dollar, the New Zealand dollar could be bought, right? Excuse me. And that just wasn't the case. So the carry trade unwind 2.0 was just another mechanism to scare the bejeebers out of everybody. And here we are moving higher. Excuse me. Coffee is just not agreeing with me today. All right. Sorry about that, gang. Hair of the dog. All right. little bit more coffee. Maybe that'll fix it. All right. So as we take a look at where we are, we have bounced pretty nicely off the anchored VWAP. Again, something we talked about roughly a week ago. I don't mind, and we're going to have to deal with sometimes price action below the anchored VWAP. Sometimes we're going to see price action close just above, just below, but we know that's where the battle is happening, that line. What we're concerned about is acceleration down through that level. I don't think we're out of harm's way yet. These are still very red candles. This is still a very bearish environment, but it's not necessarily the extreme that we were at just last Monday, not yesterday, a Monday ago, right? And you can see here, the NASDAQ, by the way, has been very, very weak. So we're bouncing within an overall weak environment. And then, so the next question is, okay, Raghee, what do we do with this? Same thing that we've been doing in the Sector Secrets Mastery. Day trade or look at a far longer term time horizon, especially this week. OPEX last month, if you recall, was a really tricky environment. So keep in mind that OPEX is going to have that intensity around those strikes that have a lot of high open interest. And so for that day, Friday, we'll have just sort of a type of day that has nothing to do with what happened on Wednesday, Thursday, and it will have nothing really to do with what will happen on Monday of next week. It's going to be kind of a bubble, a little island unto itself as those options expire. So we know it's a tricky week because there's a lot of money sitting at different strikes, and that whole idea of max pain, how can we leave the most number of options worthless, is really it's a true thing. It's not, again, it's nothing about anything other than it being a trade where some folks have written premium and they don't want to collect any less than what they sold it for. And if they can make those options as close to zero as possible, and the biggest group, right, of an entire herd of options can be left fairly worthless, that's a win for a certain group of traders who are not playing directional debits, but rather are playing the time decay credit. And those are two very different strategies. And that's what we're going to be coming head to head with on Friday. All right, so that's it. I mean, that's what we're up against right now. So we need to be really realistic about it, but find where the opportunities are. And right now they continue to be slightly longer term or very, very short term. Okay, so now that we've got that out of the way, the next thing is, well, which sectors, which commodities are moving? I'd still keep an eye on XLP. I'd still keep an eye on XLU. We have a long position in XLU that will be unwinding this Friday at latest. Staples have continued to be quite strong. That's something we've been talking about in this room here in Charts and Coffee and in the Sector Secrets Mastery for probably about 2 months now. And so we're going to continue to look at Staples and Coke. The challenge will be, and by the way, Altria, Philip Morris, Mondelez, there's a number of names in the XLP. But remember, the more that the S&P and the NASDAQ start to gain some footing, the less there will be a need for defensive posturing. Meaning, you know, if we start to see strength in the magnificence, if we start to see strength in healthcare and financials, there's going to be less a demand for staples and utilities. Right. So just keep that in mind. It's going to be a little bit of a balancing of the scales if the strength in indices can persist. But for now, these are really great looking uptrends that we want to continue to take advantage of. All right. So the next thing that we're going to then look at are bonds. A lot of folks have been asking about bonds and gold. I like gold better right now. We've got plays. Yesterday, we day traded gold. Really nice day trade for gold, GLD options. We're in Newmont Mining, which is the #1 weighted stock in the GDX Gold Miners ETF. And, you know, do I want to get long bonds? I do. They've just been very difficult to deal with because of the volatility. We had the auction the other day. So I do want to start looking long in bonds, because one thing that, you know, we noted on the 6th is that the futures, the long bond futures, have turned into an uptrend. This indicates lower yields. And yeah, we want to be able to buy some TLT calls. I'm just being a little cautious about it because, you know, we do have CPI data this week. We had bond auctions last week, and it was a fairly vulnerable uptrend. Engaging in those kinds of hot zones when there's much more of a set trend is a whole lot easier than a new vulnerable trend. But if we're going to continue to see cuts into summer of next year, we're not really seeing the sum total of what bonds are going to be doing to the upside. So we'll keep an eye on that. And then also gold, whether it's gold miners, or Newmont mining, very volatile gold market. Day trading this stuff is oftentimes a really good choice. Yesterday, on a move down to the hourly price movement range in gold, we bought calls. It was just that simple. You can see back in here, we took advantage of getting long GLD calls and took advantage of that day's action. And that's a really powerful way to deal with uncertainty. Just shorten the time frame, gang. In fact, uncertainty is best handled by shortening the time frame a lot or lengthening the time frame a lot. And sometimes the time frame is really the time frame and time horizon is sometimes the best tactical decision you can make when it comes to dealing with the kind of volatility and scares and concern and OPEX, things like that we're dealing with. Okay, that takes us to any questions that you all have this morning. No questions so far? Okay, get them in quick. All right, next up was kind of interesting. Yesterday, XLK and Apple were quite strong. And by the way, this is the 5-minute chart on the left and the daily chart on the right. And XLK is ready to do some battle, looks like, with the anchored VWAP. It's going to be very important at XLK, especially for the NASDAQ and the S&P. It's going to be very important that the XLK take out that resistance at the anchored VWAP. Here's Apple. Yesterday was Apple's first candle out of the red, out of those bearish top tier candles. And we saw also, I think, a little bit of strength in things like Meta, right? I don't want to be buying these things near the highs. So what do we know? Okay, Rog, daily time frame Meta, green candles, yellow candles. So since the 6th, buying the yellow or the green candle in the gray is the path. And we're going to continue to keep an eye on that. Amazon was up yesterday too, but it's still a red candle. So no buys on Amazon. So what we want to do right now is differentiate between which of those Magnificent Seven, or this applies to any stock, but which of the stocks that we are looking at in terms of green candles or yellow neutral candles, which one of those could get us set up for continued upside. And yeah, I'm still bullish, gang. I'm still bullish in terms of the overall expectation I have. Just not everything is buyable. So to be bullish doesn't mean we buy all the things. It just means that we have a list of names that if they sink into the zone, we would actually be very interested in getting long calls or getting long in. In fact, we continue to buy for the longer term. I think the two most recent, actually, let me bring in the weekly chart here for a moment, because I'm talking a lot about, day trading and keeping a short-term narrative, but what about the longer-term narrative? Let's bring that weekly chart in here. All right, here we go. So if I'm taking a look at the weekly chart of the say some of the symbols that we've been buying, I'll give you an idea. This was the first one we started off with was XLF. So we bought dips there. The other one was XLB. And I'll talk more about these when we have our session later on today, some of these longer term weekly levels that we want to keep an eye on. Now, when I talk about weekly, by the way, gang, what I'm doing is I'm going into shares. I'm buying shares. I want to be cognizant of what the cost is so that we could get into something that's scalable, right? So we'll be keeping an eye on a lot of these. For those of you that are wondering what happened to the weekly on the unwind scare, we had a mean reversion, right? Take a look here. This was a mean reversion on the SPY. So weekly time frames, if we have the appropriate longer term comfort level with a name like XLB or XLF or whatever it is that you might be looking at, if you've got that at least 6-month time horizon, there's a lot of value in looking at these names as well. All right, so let's get this weekly chart out of the way. And again, shares, right? I'm not looking at leaps, although you certainly could. And how come I can't get this thing to get out of the way? Oh, Toss, you're just angry with me today. There we go. Okay, back to the daily. All right. So what are my thoughts on USO? Sure. So if we're taking a look at USO, we're actually looking at crude oil, right? And crude oil had a really good day yesterday, but this is where I'd say this is, that surge higher, kind of a lucky move, right? This is not a getting long USO underneath the VWAP. Getting long USO when it started off life as a red candle. Sometimes we're going to get those lucky days where things just surge within the context of a downtrend. That's not something that if you were to do that 100 times, I'd say 90 out of 100, that's going to be, for the most part, a losing trade. But every now and then, you're going to have a surge, and that's great. The challenge here is that crude oil futures are still very much in a downtrend. So be cautious with getting too bullish USO, crude oil, and most of oil stocks. To be quite frank, I think the only bullish name in oil stocks continues to be Exxon. So if you are looking at, there we go, CL or USO, be nimble about it, because that was a surge within an overall downtrend. And hey, look, I'd rather be lucky than good, but sometimes we have to chalk it up saying, oh, that was kind of lucky that it moved the way it did within the overall downtrend. And of course, geopolitics and whatnot can oftentimes, and I believe OPEC's been pretty vocal this week too. So we can get these kinds of moves on weeks like that. All right, next up is X asks, the gold-silver ratio is at an extreme. Okay. Is there a way to use the indicator to do a pairs trade? X, I don't do pairs trades, and I have, so anytime, and so please know the difference, gang. If I'm going to share something with you all in terms of a strategy, some of you might remember we had a pretty lengthy video on Friday where I walk through the sum total of, for those of you that want to trade S&P futures, SPY, SPX, puts and calls, how to do it. I gave you all a video on that because I've got literally hundreds, if not thousands, of trades using that process. So it's not that it may not be a good one, X. I just don't use it. And until I've got so just to give you an idea, gang, of before I say anything about an indicator or a strategy, know that it's at least, and I don't think I've ever done it on the shortest end of this, it's been at least tested, not back tested, forward tested, meaning actual trading with a concept for 6 months. Most of the time, it's going to be closer to 12 to 18 months before I say something is working, right? Not that, hey, I figured this out last month and look how good it's working. That's not good enough, right? We need to have a forward testing of at least 6 months. So until I've used something, anything, it could be an indicator, a strategy, anything, for at least 6 months, forward testing, actual trading, the current environment, I think it's kind of, irresponsible for me to say anything about it. So I just don't have any experience doing that, X. I'm the only pairs trading that I like to do is the Forex. And if you want to talk about Forex, right, I'm happy to talk about that till the cows come home. I've been trading that since 2000. So that's 24 years. But yeah, so X, I just don't have the trades to tell you I've got a repeatable process. And be aware of that, gang, because you're going to get bombarded by a lot of folks who said, hey, I just figured this out 6 weeks ago. Yeah, now go tell me if it's been working 6 months later. And that's where, for me, something like a gold-silver ratio would end up, where I just don't have the track record, frankly, to say, hey, this is working in all sorts of seasons and behaviors of the market. All right. So thank you for the question. Now, I would tell you, I like gold a lot. Silver can be a very challenging metal. But I'll tell you this, X, I like to keep an eye on gold because it's a play on real yields. And I like to keep an eye on copper because it's oftentimes a symbol of economic optimism and expansion. And when it's not doing that, it can sometimes be a symbol, a metal of, in this case, a lot of folks look at copper as another way to gauge inflation, right? That's another thing to keep an eye on. All right. So that's it, gang. That's what we've got going on here as we go into CPI tomorrow. We do have some Fed members speaking as well. Keep an eye on that calendar. I think a lot of folks got blindsided by the calendar yesterday. So make sure you understand that day trading clock, right? There is a rhythm to the day. There are economic events we have to be aware of. And I think yesterday's late mid-morning sell-off is just a great reminder of, you got to know the day trading clock. You got to know those those events on the calendar. All right. And those are all things we cover in the mastery. So I'll see you all there in just a bit. Gang, be good to each other. We'll be right back here tomorrow, 9 to 9:20 for Charts and Coffee.